Welcome to Global Investment Insights, a weekly podcast brought to you by ADCB Asset Management. My name is Kishore Muktinutalapati, an equity strategist for ADCB. With an objective to empower you with investment insights, on this program we discuss various perspectives shaping the global investment landscape. Continuing with the mid-year outlook series, after covering macro, equity, rates, and credit outlooks over the past weeks, this week we bring you some perspective on currencies. When it comes to currencies, there are a range of fundamental factors that determine the value of a nation's currency. At its simplest, a currency is to a nation what a stock is to a company. Just like the movements in share prices reflect the changing perceptions of traders on a company's worth, movements in currencies reflect the changing opinions of traders on a nation's prospects. As such, the drivers of a currency value include economic prospects for growth of a country, inflation rates and forecasts, trade balances, money supply, credit ratings, currency pegs if any, and more importantly, the currency reserves. Adding to the complexity in the forex market, the value of a paper currency is generally expressed in terms relative to the value of the other paper currencies rather than in absolute terms. This brings in the concept of currency pairs. Therefore, some of the drivers we discussed just a moment ago will need to be considered on a relative basis to understand and project the movements in currency pairs. For example, Euro-USD rate is influenced by how the economic prospects for the Euro area are faring in relation to the economic prospects of the United States. Further, currency trading has broader applications other than investing. For instance, multinational companies use forex markets to transact in various currencies. No wonder, with close to $7 trillion in daily volume, the forex market is arguably the largest financial market in the world. With that brief background on forex markets, let's get some perspective on how a couple of key currencies are doing and what their outlook is. To provide her perspective on this, we welcome Prerana Seth, our fixed income strategist. Prerana, thank you for joining back on this program.
It's great to be back here again, Kishore.
One thing that stood tall amidst the market turbulence this year was the US dollar. Broader US dollar as measured against a basket of currencies rose circa 8% this year till mid-July before pairing some of its gains over the past 2 weeks. Prerana, do you think the US dollar, or the king dollar as some may like to call it, has peaked?
So with signs of peak growth, peak inflation and peak bond yields, there is now increasing evidence that the dollar's rally may have also peaked with the currency looking overvalued. However, what we've seen is that the dollar strength has failed to wane despite brief periods of weakness over recently seen. Repeat of the US dollar's phenomenal performance in the second half of the year looks difficult with the ease in inflation expectations and signs of moderation in supply chain bottlenecks. And hence we believe that the momentum in dollar strength could slow, particularly with Fed projections matching market rate hike projections, and in fact now Fed projections looking way more hawkish compared to market rate hike projections. At the same time, signs of weakness in US economic activity could also give the dollar rally a breather, as this could potentially reverse the Fed's current hawkish stance. Having said that, we do not anticipate significant dollar weakness. The US dollar, being a counter-cyclical currency, could still benefit from continued supply chain concerns and unyielding geopolitical tensions. And not to forget, Fed is still the most aggressive central bank with its tightening stance. As long as this is the case, wide short-term interest rate differentials mean that the dollar will continue to shine.
What about the outlook for euro? Given the range of headwinds facing euro area this year, we have seen the euro recently hit a parity against the US dollar for the first time since 2002. But now, given the European Central Bank has raised interest rates for the first time since 2011, has anything changed for the currency?
So we believe that euro still is likely to remain under pressure, as the ECB is unlikely to match the Fed's aggressiveness. The sudden and fast unwinding of ECB's loose monetary policies could have repercussions for the region, especially for the periphery countries. And ECB is mindful of these risks and has been quick to respond by introducing an anti-fragmentation tool called the Transmission Protection Instrument in order to backstop the periphery spreads. But what we believe is that the ECB could in fact be more patient and adopt a gradual tightening stance, and this could perhaps delay the possibility of a strong euro rally. Having said that, euro stands to benefit from a prospective cyclical rebound in China's economy. While we do not anticipate a complete shift in the current currency trends, but we acknowledge that the scope for significant weakness in euro is looking increasingly difficult. Hence, we are slightly less negative on our outlook on euro in the second half of this year.
Prerana, as always, thank you very much for your thoughts and insights.
Thank you, Kishore.
Thanks for listening. We hope you found this podcast useful. If you did, please do share this and other episodes with family, friends, and colleagues. For more information on what was discussed on this podcast or to access our latest quarterly investment view report, please reach out to your contact at ADCB. This concludes the podcast series discussing our mid-year outlook. My name is Kishore Muktinutalapati, and I will be back next week with more global investment insights.